European problems have persisted. We see no solution coming from that EU finance minister meeting over the weekend. The fear is back on in the market. What do you take from the developments over the weekend, and is it signaling another financial crisis on the horizon?
I think it's the uncertainty. I mean, we've had last week, we started the week almost on a similar footing to what we're seeing this morning. You must remember that the market's waiting for some form of clarity. We were hoping that this weekend there would be some form of resolution reached, or some form of line in the sand with regards to this Greek outcome. They still have to take Troika to Athens to talk about cutting back on the deficit, etc. And now there's talk about a lot of public servants in Greece losing their jobs, etc., which unfortunately obviously poses negativity in the Greek sovereign itself, and then the concerns around what the impacts of a default in Greece ultimately mean for the rest of the Eurozone. So the uncertainty is definitely still back on the table until we get some clarity, and unfortunately we're at the hand of politicians, which don't necessarily mean that we're going to have a speedy outcome in terms of what we're really likely to see. So the sentiment's very nervous, very jittery. Markets back at the levels that they were last week. We're back at those, not as significantly dire levels on the euro, but you are seeing it play into emerging markets, and you've seen on the local market rand up at 760.
Now, data from the Commodities Futures Trading Commission says that investors have significantly increased their shorting positions on the euro, and those shorting contracts are sitting at levels not seen since last year, June. If you look at what that's telling us, that markets are pricing in that Europe's problems are not going away anytime soon.
That's correct. So if you look at the CDS spreads, if you look at the bonds in Greece, if you look at investors unbundling euro, you're looking at a zone that is almost pricing in the likelihood of 100% likelihood of a default. So for now, the market unbelievably insecure, just because we don't really know what the ramifications of that are going to look like, what the feed through into the eurozone, and then obviously this global growth backdrop, which impacts all of us with regards to emerging markets and other, lesser developed sovereigns. So, I think the uncertainty with regards to how this global backdrop has deteriorated over this year and what the outlook looks like, definitely not positive at all. And in fact, that's why you're seeing this risk-off move across the board.
750 was a key level for many commentators from the local currency point of view. Now we've passed that level, sitting almost at 760 at this stage. Is 8 Rand in sight this week?
Well, I don't know about this week, but anything can happen. I mean, the markets at the moment, like I said to you before, it's very difficult to, to make a call based on the fact that we are very uncertain about what the outcome's going to be with regards to the eurozone. So, you're seeing bonds back. We've, our bonds retraced nicely prior to the beginning of last week. We were down at 632 on the 157. That's retraced back another 60 basis points. We saw a little bit of a move, strengthening move at the end of last week, but that's been sold off again as the rand's weakened. So it just shows us that the interest rate cuts that we were looking for potentially aren't going to come through to the fore, certainly not before the end of this year, with the rand remaining weak, and the the inflationary implications of a weaker rand. Obviously, with the growth momentum globally, it's definitely something that we're watching very, very closely.
Yeah.
And also from a global perspective, you're seeing the US Treasuries rally. You've seen the gold price uncertain because it's traded all-time highs. So the market is just really, really in a place that it doesn't know where to put its money, because the market is so uncertain of what risk looks like and what a risk-free asset looks like right now.
Yeah, that is being put into question, but of course we see the dollar and gold, and as you say, US Treasuries are rallying today. When it comes to the local data that we're expecting out later this week, we've got CPI data as well as retail sales. Firstly, with CPI, what are you pricing in?
Look, we're looking for 5.5. Obviously, it's ticking up constantly. The last number came in at 5.3. With the rand at these levels, you'll see MPC likely to talk about the rand being a lot weaker, what the implications of that are. We're a net importer still. Obviously, the exogenous factors, so all the imported price costs, administered price costs, etc., still have to come through the system, and those pose upside risks to inflation. So from that perspective, we're looking for the interest rate decision this week. We at Nedbank are calling for a flat rate decision, looking for flat rates for the foreseeable future, as inflation still does remain something that does pose a risk to the top side, despite the fact that the global growth scenario is looking as dire as it is.
What are yields on the bond curve telling us this morning about where the markets are pricing in a cut going forward?
Well, the markets initially had pricing quite aggressively for a cut, with the short end of the curve down at around that 632 handle. A little bit overpriced, in my opinion. We saw it come back, and we've seen the yield curve flatten quite nicely. In fact, last week it was trading at about, on the 186.157, which is the 15-year stock against the 5-year stock, trading at about 138 basis points. We are coming into an auction tomorrow. More long-end paper being auctioned. We've got 214s and we have 186s on auction. So that's steepened up the bond curve slightly, and post the auction we expect further flattening to persist.